Welcome to the deep dive video update. This is one of the last videos that I do over the weekend where I have some charts that are unique just to this particular video, but I have some other charts that sometimes they're in the daily video, sometimes even in the weekly video, and then sometimes they're not. And then I put them into this particular video and we have to look deeper. That's the reason for the name, deep dive. We have to look deeper to see, are we getting any clues from these other charts? Even though we have other charts in the daily and weekly videos that seem to be telling us something right now, we might miss some clues. So I put them together into this particular video. And this is being prepared from Monday, November 3rd. The first chart is only for this video. It's a long-term range of the VIX. The VIX is on here, but it's turned invisible. Over top of it, I have a 50-period exponential moving average, and we are in a lower range. That's positive for the market. Now, we were starting to tick back up here a little bit, but now, at least over the last couple of weeks, we've been more positive, and we had a positive week, so we're starting to come back down. That's not what I'm focused on. What we're looking at is in the bigger picture. Are we above 20? Are we below 20? When the market's more negative, we go above 20 for long periods of time with the VIX. And when we're below 20, that's when the market is usually going up. And we're still below 20 and the market's been positive, just coming off of recent all-time highs. And by the market, I mean the S&P 500. Now, I like to measure the momentum of the VIX, and I use a MACD to do that. It's one of the first momentum oscillators that you might learn when you start studying technical analysis. It's one of the first ones I learned, but it really hasn't been all that insightful. It's been flatlining as we worked our way through the summer, kind of drifting up a little bit. That could tell us a little something there. And then we really spiked up. We had that big down day back in October, and the VIX really went up, and then we've been coming down ever since, and that's what the momentum is showing us overall. But we also want to look for extreme moves. When the VIX moves really fast and we start to get above 70 or below 30, that's what the RSI short term based on 9 periods measures. Not really, we're just around the midpoint right now. So the VIX hasn't been moving all that much, at least as far as speed. And then there's the S&P to VIX correlation. We were really focusing on this, and this was giving us a heads up before we saw that big down move in about the middle of October. And this was flashing a warning sign that we weren't getting from other charts. We were seeing it in some other studies that we look at. And then after we had that big downward move, this correlation really dropped off, and now it's pretty much neutral. And then this is another chart we've been watching, and it kind of comes and goes out of the daily video. This is the VIX to move ratio. The VIX measures the volatility of stocks. The move index measures the volatility of bonds. And when this is going up, that means stocks are more volatile than bonds, and volatility usually means going down. And so this red line, which had been declining after we got through all the gobbledygook in April, and then we started to come back down, and that was when the market was doing better. Now, it's not that we're doing bad now. It's just that we're seeing a general shift in the character of the market. Going back about partway through September, we started to see this line turn and go back up. A little bit of a warning sign. Just tuck that in the back of our minds to say, okay, stocks are becoming more volatile than bonds right now. That may lead to some negative price action at some point. And then we look at another ratio of the VIX to the VVIX. The VIX measures how fast the VIX is actually moving, the VVIX. And it's the volatility of the VIX. And it was going back up. That means the VIX was more volatile than the indicator that's used to measure the volatility of the VIX. And it's really confusing. It's actually been coming down a little bit now as things have been a little bit more subdued lately. And then the SKEW index, which is a variation of the VIX, where the VIX uses at-the-money options. Wherever the S&P is at any given time, the options that are closest to the current price, those are called at-the-money options. Well, the SKEW index uses out-of-the-money options, options that are above and below, either calls or puts, based on the S&P 500 itself. And when we get up into this red area, that means the market is expecting some kind of a big move. We were up there, and then we have now dropped down, and we're more in this neutral area for the time being. And the Ulster index, which was really starting to go up above the moving average here, this is like an end of day sentiment gauge that was really designed for mutual funds And so there's really only one price to this, and it's just updated after the market closes. That's why it's only a line chart and not a bar chart. But we dropped underneath the moving average now. And so when it's underneath the moving average, I don't show it in the videos, daily videos. Now we're seeing a little bit of a move up here with large cap to small cap ratio. When this is going up, that means the large caps are outperforming. When this is going down, that means the small caps are outperforming. But really, we started to come down into a lower range because the market had this scenario, and half of it turned out to be true, that the Fed was going to cut rates in October. Well, they did that. And then the market was also figuring, okay, they're going to cut rates in December. Well, then Powell came out this past week and said, well, we don't know about December. Well, small caps like lower interest rates, and that's really put some pressure on small caps, even though they bounced up a bit on Friday. And that's why we were seeing this ratio coming down. As small caps were seeing a little bit of favor. Now that it doesn't really seem that it's a done deal with the rate cut in December, now we're seeing this ratio starting to go back up a little bit. And then large cap growth, this is the real driving part of the stock market, just coming off of recent all-time highs. I only show this usually if we're hitting an all-time high, if we're dealing with one of these moving averages. I have it here just to show it to you that we're really not looking all that bad, at least yet. We are coming down a little bit now, and the market appears to be a little bit vulnerable currently. But when you look at the bigger picture, it's still looking quite positive. And then this is just for informational purposes. I have it only in this video, and I actually extended the chart out a little bit here. When we go back to the October 2022 low, we're up 95.74% from that low. And then we set another major low in October 2023. Of course, we didn't know it was major at that time. We can really only look back and go, oh, wow, that was pretty major. We're up 66.68% since the October 2023 low. And then we set another fairly significant low here back in April, and we're up 41.47% from that low. So the market's really doing quite well on a percentage basis. This is a similar chart, but I have to monkey around with these lines, and you move them just a little bit and the percentage kind of goes. What if we start to go down with the S&P, we'll really begin to pay attention to this chart more. We want to know on a percentage basis, if we put it high in here and then we start coming down, what's the percentage of the decline? Because when we get around that 10%, that's quite often, at least in the past, here was 10.75 on an intraday basis. Here was just under 10%. Then we see the smart money coming in and starting to buy. So if we come down and we see about a 9-10% decline, if that even happens, and then we're watching a lot of support levels, we're watching to see what's volume looking like, and if we start to see a bounce up out of that, this is the smart money coming in and actually doing some buying. But right now, we're just kind of floundering around, so there's really no use to show this chart in the daily videos. Then we look at an advanced decline ratio based on 19 periods. That's short term. Now, the takeaway from this is we're actually below zero when we look at this based on price. We are declining, but still above zero based on volume. Now, that's still kind of leaning more positive when we see volume holding up better than price. Now, if they both drop down below zero, that's going to turn this more negative. I have a variation of this chart just showing price that I show in every daily video. And then we look at the advanced decline line, number of different studies here. This is the S&P. We look at the cumulative advanced decline line based on price, just coming off of recent highs and then seeing some weakness. Also coming off of recent highs here when we look at this based on volume. And then we look at the S&P and the NYSE advanced decline line together. You can see the broader market seeing a little bit more weakness when compared to the index itself. This is an apples to oranges comparison. And then the NYSE advanced decline line, cumulative, just setting a new all-time high here. My goodness, that's still looking pretty solid from a broad market perspective. Now we're coming back down. Now this is a regular NYSE advanced decline line, back down to the 50-day moving average here. So seeing a little bit more weakness this way. And then another NYSE advanced decline line, which is calculated in a slightly different way, also dealing with its 50-day moving average. And then the common stock, seeing some weakness here, didn't really set a recent all-time high here based on price. We did set a high based on volume, but it was not confirmed by price. And typically when volume is outperforming price, that's more positive. Well, so far that really hasn't worked out on this chart. And then a 10-day average of the highs and lows for the S&P. This is longer term. We're still above 50. That's the real takeaway. Seeing a little bit of weakness here, but we're positive since we're still above 50. And then a 5 period moving average of the highs and lows across the broad market. We are declining, but still above zero here. So still hanging on a little bit longer term in a broad market perspective, looking pretty positive there. And then we look at momentum stocks and do a ratio with the S&P. We are seeing a little bit of a tick down after we've been pretty much range bound here. Now, one takeaway from this is when we were really going down in April, in March and into April, momentum stocks were holding up better. They were actually outperforming. Not that they were going up, they were just going down less at that time than the S&P was. And now we're seeing this trailing off just a little bit here, where momentum stocks are actually underperforming the S&P. And then this is still sideways when we look at a ratio between US and international stocks. And then we have technical alerts here, and I go through these in every daily video for that particular day, but this is the whole week. And we start at the bottom, that's Monday, the first one that was registered. At the top is Friday, and really we just look at the colors. If we're having a bad day, it's red. If we're having a good day, it tends to be green or blue, whatever color you see here. And then we use technical scores. Now you can do this with individual stocks. I think you can do it with mutual funds, but I'm not quite sure about that. I use it with indexes, and we try to remove all emotion. And I look at 6 different indexes and say, okay, what is performing from a pure technical analysis standpoint? And stockcharts.com, they put together this criteria to say, okay, here's the score. The higher the score, the better looking, in this case, the index. Coming in first place is the NASDAQ. And it's been doing pretty good here. This is the 1Q, that's the ETF for the NASDAQ composite, and it's at 92.5, and that's a good solid score. In second place, also respectable, are the QQQs, which is the NASDAQ 100 at 90.4. In third place, which is more of a balance between growth and value, we have the S&P at 80.3. Then we have small caps, actually holding up fairly well here at 79.3. Then the Dow, which is improving here, but it's not doing great when compared to other indexes, coming in at 72. And then in last place, and actually looking more negative because it's below 50, we have the mid caps, which are at 42.9. Then a short-term rainbow going from 10 periods up to 50 periods. Even with us pulling back here, we're still above the rainbow, and the rainbow's still going up. The short-term trend, at least for right now, remains positive according to moving averages. And then we want to keep an eye on the 20-period simple and exponential moving averages. We're still above that. Now, if we start coming down more, and this is looking a little vulnerable here with this current chart pattern, lower highs, lower lows over the last few trading sessions, are we going to see more follow through to the downside? If we do, this chart will quickly go back into the daily video because we're going to be seeing, will the 20-period moving averages provide support? Then intermediate term, we have another rainbow going from 50 periods up to 100. Intermediate term trend is still quite positive. And then we look at the 50-period moving averages. Now we're kind of far away. There's an indicator called a boom indicator where I measure how far price is from the 50-period moving average. I also do it with the 20 and the 200-period moving average. And we're kind of getting far away here. So that's a little bit of a concern, but sometimes that can also mean the market is more positive. Now, if we drop below the 20-period moving averages, the next one that I'll be watching will be the 50-period moving averages. And we really haven't tested those after we came up out of the April lows. We've been mostly dealing with the 20-period moving averages. And now if we break those for some reason, then this will be the next layer that we start to watch. And then the 100-period moving averages still looking really positive here. These are anchored weighted moving averages, and we haven't even come down to this orange one. This has been acting as somewhat support when we had more downward moves here, but we didn't even break that. And so I haven't been showing this chart because we're above all these moving averages here, and all the moving averages are still going up, and that's positive. Now, this was in the video earlier on when we were really screaming to the upside. The CMB composite was getting extreme. Now that we've been calming down and actually seeing more negative action, this has been coming down as well. And then Connor's RSI, pretty much at the middle here. We just look for extreme positive or negative readings. The Bollinger Bands, which we were watching this because we actually closed for a few days above the upper Bollinger Band, and then we started to come back down, and that's worked off the percent B indicator. And we want to keep an eye on the S&P 100. Not really seeing much of a divergence here with the S&P 500. Now, earlier in the week, we had some green X's drawn in. The first part of the week was quite positive. We were setting all-time highs. Everybody's singing and dancing. And then Powell came out and just ruined everybody's week and changed the whole shift as far as the attitude of the market to like, okay, we're probably not going to, or we might not cut rates. It's not a done deal. Don't put a fork in it yet. And that spooked the markets a little bit. But before that happened, we were looking pretty solid here with the point and figure chart. A long-term rainbow, 50 periods up to 250 periods, long-term trend, still quite positive there. And then a daily special K chart. This is a long-term oscillator. That is positive. And if you watch the weekly video, the weekly chart is also positive. Then this is a weekly chart of the S&P 500, a weekly chart of the German DAX, more neutral, where typically we see what's going on with the German index longer term and what's going on with the US index, the S&P longer term. We see a pretty strong correlation. They've kind of been decoupling a little bit here lately. And then some support and resistance. I pull this out when we start to come down. This is a 20 period simple moving average of the open, high, low, and close. A lot of times when we're above this rainbow, we come down and one of these lines may provide support. Now, we're not there. But the positive thing about this chart is the rainbow itself is still going up and prices above the rainbow. And then we have an Ichimoku cloud, still looking quite positive here. First, we look at the green line. That's positive. It's going back up after it had been declining. And then intermediate term is the blue line, and that's above the red line, which is longer term. And all these lines and price are above this green cloud. So this start is still quite positive. And then we look at the VIXen. Gotta love that name. That is the volatility measure for the NASDAQ 100. I don't follow it all that close. I'm mainly focused on the VIX. And then the Qs, which is the ETF for the NASDAQ 100, we're above all of the moving averages here. And so that's just looking more positive overall. So this is a very helpful chart. And incidentally, you might hear some background noise behind me that I can't really control right now. Just think of it as uh, mood background music, if that's what you want. Okay, and then another study that we look at is the S&P on top. And then this is designed to be a growth to value ratio. The Qs, which are growth, to diamonds, which is the Dow. And those are considered to be the best value stocks, even though there's growth stocks in there. And then we look at the correlation between the two, and it's pretty strong. And this, for the most part, this ratio has been going up. That means growth is outperforming value. And the S&P's been going up, although seeing a little bit of recent weakness here. We look at the Dow and the transports just to keep an eye on those. The Dow's just coming off of recent all-time highs, but we're just going sideways here with the transports. And then we want to keep an eye on the bank ETF. It really took a bit of a hit after there were some earnings. Now the big banks are doing fine. The smaller banks we need to keep an eye on because it was a couple of years ago when we had Silicon Valley Bank. They came out with some problems maybe 2 or 3 years ago. And then Republic Bank and New York Community Bank. And that's when interest rates were starting to go up. And those banks really got caught on the wrong side of things. And then there were some reports coming out that might be some fraudulent loans have been taking place in some of these banks. And so the ETF has been getting hit. We came all the way down to the 200-day moving average. So far, we've been able to stay above that, and we are still in an uptrend here, but we want to keep an eye on that because we're also really watching the financial sector, which continues to underperform the S&P. And we really haven't been told why, if there's even a reason behind that. Is the financial sector going to come back and start doing better? But we've been going back to last spring and seeing this continual underperformance of the financial sector to the S&P 500. So we also want to keep an eye on this. And then here's the financial sector itself. And then I do a ratio with the regional banks, the smaller banks. Not doing all that great. They are in an uptrend. We saw enough of an upward move to produce a golden cross here. But then right after that happened, we dropped down below both of the moving averages. So not a lot of strength here, but not a lot of weakness either, at least in the short term. And then we look at another ratio between energy to the 10-year bond, just continuing to go sideways here. And then this is a newer chart that is in my list of charts that I look at not as often. And this is a broad market measure of the stock market. but it's the value line geometric and it's calculated in a different way. And I only show it in this video for right now because we really haven't been getting, I mean, it's long term and we haven't had any recent things really happening. The real takeaway from this is we set a high with this index back in late 2021. And even with us setting new all-time highs with the Dow, NASDAQ 100, S&P, we have not set all-time highs with this index. So this is actually a longer-term negative divergence that we're just keeping an eye on. Now, we were kind of going along sideways. It looked like we may come back up to this trend line. We haven't quite come back up to it yet, but we'll just keep watching this. And if we do get back up to this line, then I'll probably start showing it in the daily videos, at least for a while, but because it's a daily chart, but it's longer term and it's a much bigger picture type of chart that I look at. And then emerging markets to developed markets, still pretty much range bound here. We were in a lower range throughout the summer, then we kicked up into a higher range, not really showing any conviction there. And then the US 10-year yield, and we subtract the German 10-year yield. And because US rates are higher, we get a positive result. And then, believe it or not, we plot the US dollar index down here, and then we do a correlation. Now, a lot of the time, we're up in this blue area, showing that there's a pretty strong correlation between the top chart and the middle chart. Right now, it's pretty much neutral. So is there some kind of a subtle shift going on here between US rates, European rates, and the US dollar index? We've been seeing a little bit of strength in the dollar lately, not enough to change its trend, but it's been holding up a little bit better. And the Japanese yen is now in a downtrend compared to the dollar. And the euro's been seeing some weakness, as well as the British pound. Those are the three main currencies that we track with the US dollar. The German DAX, which really earlier on, it was really doing pretty good and actually outperforming US markets and showing more conviction as we go through 2024. We had a bit of a dive here in 2023, but lately it's just been kind of floating along sideways. And then I do a ratio between US stocks and German stocks. When this is going up, that means US stocks are outperforming. Earlier in the year, European stocks were really outperforming. And then we had the big dump back in April, and then we've been coming up out of that ever since, seeing a few hiccups along the way here. But for the most part, US stocks have been outperforming. Then long-term rate of change charts, going back 250 periods, not really much of a change, kind of going in a range here and still holding up fairly well. This is very long-term. And then bonds, this is what I look at to say, okay, what's the market saying about inflation? When this ratio is going down like this, which it's in a downtrend and it's even coming down to the lower moving average, that means the market's not worried about inflation or interest rates. Then we look at another chart, pretty much going sideways here, different maturities, not really any concerns about inflation or interest rates here, and not any concerns in this chart either. So according to what the market says, they're not worried about inflation or interest rates. No matter what YouTube videos you might see that say otherwise, we follow what the market tells us, not what people are coming up with as far as their scenarios. And then we look at the S&P in red here, and then the long-term bond, which is in blue. And the the long-term correlation here is pretty strong. That stays pretty strong. We're seeing it coming down to neutral here in the shorter term with the correlation. Then we do that same thing. The Qs to the long-term bond, the long-term correlation is still pretty strong here. We keep an eye on the 2-year yield. That's shorter term here, and for the most part, it's been coming down, and that's been positive for stocks. And we want to keep an eye on retail since it's such a huge part of the U.S. economy. And when you look at the retail, which is in the middle, that's the chart itself. It is in an uptrend, but it's falling below its 50-day moving average and seeing some weakness here. And it had been declining longer term when we compare it to the S&P. We were starting to see a little bit of a drift up here, but now it's starting to show some more recent weakness. And then we look at different ratios. This is discretionary to staples, the weighted version. This is doing pretty good and actually starting to break out. Now, the equal weighted version isn't doing as good. We would like these two to kind of confirm each other because it's mainly Amazon and Apple. They're such a heavy weight in the discretionary. When they do well, this ratio really goes up. That's why we also look at an equal weight version of discretionary. And then that's not performing quite as strong right now. That's a little bit of a concern. But when we look at tech to utilities, that's doing quite well. Biotech, which is growth, to healthcare, which is value, that's doing quite well. Now, hotels to utilities, that had really been going down. It was starting to bounce back up. Now it's declining again and possibly starting to level off a bit with this ratio. Then what we call bellwether. These are the real foundation of the U.S. economy here. We have semiconductors just coming off of recent all-time highs, but the home builders, they didn't like here. They've been coming down here, and they didn't like that Powell said, well, we may not cut rates in December. It's not a foregone conclusion. And so the home builders have been seeing some weakness, going sideways with the transport, seeing some weakness, as I pointed out, in retail, and a little bit more weakness in retail banking. We want all of these to go up. Now, we want semiconductors to go up. That's a really good thing to have happen, but we would like these other ones to go up as well to be more convicted that we're in a positive environment. And then we look at the Eurozone and compare it to US bonds. So even European stocks are still outperforming American bonds. And then we have this thing called the percent of stocks in the S&P above their 200-day simple moving average. I have another version of this indicator that I use every day in the daily videos. This one I use like an oscillator, excuse me, where we either get extreme above the green line or extreme negative down below the red line. We're not there now, but we are above 50, although we are seeing a little bit of a tapering down here. A little bit of a concern. If we drop below 50, that's going to turn this more negative. That same thing, but we look at those stocks above their 50-period moving average, they are dropping below 50. That's turning a little bit more negative in the intermediate term. And there's other studies that confirm what we're seeing in this chart. And we're just keeping an eye on that. I look at stocks above their 20, 50, 100, and 200-day moving averages. But this also then looks at the mid caps, which are showing some weakness right now. Not one of the stronger areas currently. And the small caps are also seeing a little bit of less love than what they were seeing before here, where they're also below 50. So a little bit of weakness in those areas. Now this is still looking good though. This is a ratio between the S&P and Staples. Staples, toilet paper, toothpaste. Well, if we were getting ready to really roll over and go in the dump as far as the market, this ratio wouldn't be at all-time highs or just coming off of it recently. This ratio would be rolling over, and that's not what's happening right now. We did see that at the end of 2021, and we went into the bear market in 2022. We saw it, and we were getting a bit concerned here as we were going down with the tariff tiffs back last spring, but then we were able to come back up out of that, and this has been looking quite positive. But I look at this chart every day. If we start to see some real weakness in here, that might be a little bit more negative for the market. Of course, if we see this continuing to go up, that'll be more positive for the market. So thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.